Every candlestick tells a story. It represents the ongoing battle between buyers and sellers during a specific time period. When buyers manage to close the candle near its high, especially with strong momentum, it reflects clear bullish strength. But the real value of candlesticks comes when they form at key price levels. Candlesticks can give you early clues about potential market direction. In this video, we're going to talk about single candlestick patterns. You'll learn the anatomy of a candlestick, how to interpret market psychology through a single candle, how to identify key reversal and indecision patterns such as the doji, spinning top, pin bars, and the maribozu. We'll also walk through real chart examples, showing you how to apply each pattern in live market conditions with proper entry points, stop-loss placement, and take-profit targets. If that's something you're interested in, make sure to hit the like button to show your support, and subscribe to the channel if you're new here. Each candlestick represents a battle between buyers and sellers during a specific time period. Open is where the price started during the selected time period. High is the highest price reached during that session. It shows the maximum strength of buyers within that period. Low is the lowest price reached during the time period. This reflects the maximum selling pressure during that time. Close is the final price at the end of the time period. It determines whether the candle is bullish or bearish and is a key signal of market sentiment. The area between the open and close is the body, while the thin lines above or below are the wicks, or shadows. Though simple in appearance, each candlestick carries valuable information about market sentiment, momentum, and potential price direction. One of the most important candlestick formations in price action trading is the doji. A doji forms when the open and close prices are nearly the same, creating a very small or non-existent body. There are four major types of doji candles. First we have the standard doji, making a small or no real body with short upper and lower wicks. It signals a neutral market with uncertainty. We cannot make decision based on standard doji, but the next candle after doji is important. Moving forward, we come to the long-leg doji. This candle also has a very small body, but its defining feature is the long upper and lower wicks. This candle signals high volatility and strong indecision, with price exploring both sides before settling near the open. It reflects complete market uncertainty, and for this reason, traders should avoid acting on it in isolation. Instead, it's crucial to wait for the next candle to confirm the market's direction before considering any entries. Next, we have the gravestone doji. It forms when the open and close are located near the bottom of the candle, with a long upper wick. This structure indicates that buyers pushed the price significantly higher during the session, but sellers eventually overpowered them, driving the price back down by the close. When this pattern appears at a resistance zone or after an uptrend, it often suggests a potential bearish reversal, especially when followed by a strong bearish candle. Finally, we have the dragonfly doji. In this case, the open and close are near the top of the candle, with a long lower wick. It reveals that sellers initially had control and pushed prices lower, but buyers stepped in with enough strength to bring the price back up to the opening level. This candle is especially powerful when it forms at a support level or after a downtrend, indicating a possible bullish reversal, confirmed by a subsequent bullish close. Another important single candlestick formation is the spinning top, which has a small real body with long upper and lower wicks. While the spinning top itself signals weak reversals. But the next candle after spinning top provides crucial insight into the market's next likely move, when found at key levels. Now let's discuss the pin bar family. These candles all feature small real bodies and long wicks, showing rejection of price and a potential reversal. We begin with the hammer. It features a small body near the top of the candle, a long lower wick, and little to no upper wick. This structure signals a possible shift from bearish to bullish momentum, suggests that sellers initially pushed the price down, but buyers stepped in strongly and drove it back up. Closely related is the inverted hammer, which forms a small body near the lower end of the candle with a long upper and little to no lower wick. This pattern indicates that buyers attempted to gain control early in the session but faced selling pressure. While still a bullish reversal signal, it is generally considered weaker than the traditional hammer and requires confirmation from the next candle to validate the reversal. It becomes more reliable when it appears at or near a strong support level. On the bearish side, we have the shooting star. This candlestick has a small real body near the bottom, accompanied by a long upper wick and little to no lower wick. His pattern signals potential bearish reversal. It shows that buyers tried to push the price higher, but sellers regained control and forced the price back down by the close. Lastly, the hanging man shares visual similarities with the hammer. It features a small body near the top and a long lower and little to no upper wick. Like the inverted hammer, it's weaker than the shooting star and should be used cautiously. Confirmation is essential. It indicates that sellers attempted to drive prices down during the session. Although buyers managed to recover some ground, the presence of selling pressure at the top of the trend hints at possible exhaustion. Now let's discuss one of the most visually distinct and impactful candlestick patterns, the Marubozu. This candle is unique because it has a full body with no upper or lower wicks. It reflects strong directional control, either complete buyer dominance in a bullish Marubozu, or overwhelming seller pressure in a bearish Marubozu. When formed at key zones, Marubozus serve as powerful confirmation. Let's categorize single candlestick patterns by their reversal strength. Dragonfly Doji, Hammer and bullish Marubozu are bullish reversal patterns. Gravestone Doji, Shooting Star and bearish Marubozu are bearish reversal patterns. Now, let's put this knowledge into practice with real chart examples. In this example, the price retraces back to a well-established support zone, where a long-legged doji forms. This particular candlestick reflects significant market indecision, with both buyers and sellers actively testing each side of the range. At this point, we don't rush into a trade. Instead, we wait for the next candle to provide confirmation. If the next candle closes bearish, we stay out. If the next candle closes bullish, it confirms buyer strength, a potential buy entry. In this case, a buy entry can be placed at the close of the bullish confirmation candle. The stop loss should be set just below the low of the long-legged doji to manage risk effectively. The take-profit target is set near the next identified resistance level, aligning with the likely upward. In the next example, a dragonfly doji forms directly at a well-defined support level, a strong indication that buyers are stepping in after a period of selling pressure. The long lower wick shows that sellers pushed the price down significantly, but buyers managed to bring it back up to close near the open, reflecting a clear rejection of lower prices. This pattern is a bullish reversal signal, especially when it appears at a key support zone. A buy entry can be considered either at the close of the dragonfly doji or after a slight pullback on the following candle for a more favorable entry. The stop loss should be placed just below the low of the dragonfly doji. The take-profit target is set at the next significant resistance level. In this setup, a gravestone doji forms right at a key resistance level, a classic bearish signal indicating that buyers attempted to push the price higher, but sellers ultimately took control and forced the price back down by the close. The long upper wick shows a clear rejection of higher prices, which is a strong indication of potential trend reversal. This formation is especially significant after an uptrend or near a known resistance zone, where market momentum tends to weaken. A sell entry can be placed at the close of the gravestone doji, or after a slight retracement on the next candle to secure a better risk-to-reward setup. The stop-loss should be positioned just above the high of the gravestone doji. The take-profit is targeted at the next significant support level, where price is likely to find buying interest or slow its decline. In this example, a resistance level has been clearly established, and the price eventually retraces back to that resistance zone. At this point, a spinning top candlestick forms, a clear signal of market indecision. However, what happens after the spinning top is crucial. If the next candle closes bullish, we remain cautious and stay out of the trade, as this suggests that buyers may still have momentum. But if the next candle closes bearish, it indicates that sellers are beginning to take control, and the market could be preparing to move lower. In this case, a sell entry can be placed at the close of the bearish confirmation candle. The stop-loss is set just above the high of the spinning top to protect against invalidation. The take-profit target is positioned at the next key support level, aligning with the anticipated downward move. In this setup, the price pulls back to the lower trend line of an ascending channel, where it forms a hammer candlestick, a classic sign of bullish rejection. The long lower wick shows that sellers attempted to push the price lower, but buyers stepped in aggressively and drove the price back up by the close. This price action reflects a potential continuation of the prevailing uptrend. A buy entry is taken at the close of the hammer candle. The stop-loss is placed just below the low of the hammer to protect against false breakdowns. The take-profit target is set near the next projected higher high within the ascending channel, aligning with the trend's natural structure. In this example, a resistance zone is clearly established, and the price retraces back to that resistance area. This pullback presents a potential decision point where a bearish Marubozu forms, a strong indication that sellers are in full control. However, because the candle is relatively large, entering immediately may result in a poor risk-to-reward ratio. Instead, it's wiser to wait for a minor retracement on the next candle to achieve a more favorable entry point. A sell entry is taken after a slight pullback, ideally toward the mid-range of the Marubozu candle. The stop-loss is placed just above the high of the Marubozu candle. The take-profit is set at the next significant support level, in line with the expected continuation of selling pressure. Remember, single candlestick patterns are the building blocks of price action. They give early signals of reversals, continuation, or indecision. But these patterns must be read in context. If you found this video helpful, don't forget to like, subscribe, and hit that bell icon so you never miss our next video. If you have any question, drop it in the comment below. Thanks for watching, see you in the next video.